This is Mike Banner, and welcome to this week's episode of the 62WhoKnew podcast, the podcast that brings you all the information, services, and things that you need to have a great retirement to make the last 30 years of your life the best 30 years of your life. And this episode is our first 62WhoKnew Inside Edition. No special guests today, just our incredible sponsors and experts in the long-term care insurance business, in the in-home care industry, and myself talking to you about the use of home equity during retirement. And it's going to be inside lingo talk, things that consumers need to know, but I think things that inside all our industry needs to know and sometimes forgets. So we didn't pick straws or anything like that. So I think I'm going to start with our best topic. And our best topic has been, for the 5 years that the TV show was on, and now the podcast, is long-term care insurance. That has always been our audience's favorite. So Cassandra, I hate to put you on like that on our first Inside Edition, but you're an encyclopedia. You're a plethora of knowledge of this. And it's so misunderstood. It still is, like my world of use of home equity, so misunderstood by the masses. Tell us some inside stuff that people need to know.
Well, thanks after that. Man, I don't know.
I'm leaving now. Cassandra's taking over.
Right. Goodness gracious. I need some practice. Yeah.
No, you don't need practice.
Well, thanks. Thanks for letting me do this. I'm looking forward to sharing with you guys a few things. When we first started talking about this, I kind of had the idea that maybe we would launch into the different types of long-term care policies. And we're going to do that, but I think I'm going to back it up a little bit further and talk a little bit about like the foundation of long-term care policies. So for some people listening, and probably for you guys, John and Mike, this will probably be a bit of a review that you may not need, but what's life without some history? So long-term care insurance, the dawn of long-term care insurance was in the early mid-70s. I want to say GE wrote the very first long-term care policy. And if you guys have been around for a while, you know that ultimately Genworth spun off of GE several years later. And today, Genworth remains the largest payer of long-term care insurance claims. So we do have kind of a through line in the industry that starts back in the 70s and kind of goes through to today. And if you've been in the industry for a while, you might think that long-term care insurance is amazing. You might also think that long-term care insurance is controversial, or maybe long-term care insurance is a dying or a dead product. And I am here to tell you that long-term care insurance is one of my children. It's one of my babies. And I could not disagree more about long-term care insurance right now. But understanding some of that early history is important for us to understand why maybe some of the industry feels that way about long-term care insurance. And so some of those early policies, like imagine anything you know in life that's been done for the first time. Like those early policies in the 70s, it was like actuaries were sitting around and they just kind of threw a dart at the board and they were like, let's see how this goes. And so they used a lot of the knowledge of life insurance pricing to price long-term care policies, right? That was what they knew. They had an idea of generally how many people went on claim for life insurance, generally what the lapse rates were, the differences in the genders, right? They knew these things for life insurance. So they said, this is kind of the best we have to go off of. Let's price our long-term care policies with that data in mind. Well, as we know on this side of things, that was very far from reality for how the policies ended up playing out. People lived a lot longer than those early policy generations anticipated. People needed a lot more care than they expected. Women outlived men by a large margin. And probably one of the biggest things in long-term care pricing from those early days to now was the lapse rate. So life insurance is priced with a lapse expectation. So what that means for anybody listening who doesn't know is that the actuaries know that there are a certain amount of life insurance policies that are going to lapse for one reason or another, non-payment, or they no longer need the policy, or whatever. So that lapse rate for life insurance, I think at one point I heard was priced at around like 6%. The lapse rate for long-term care insurance ended up being less than 1%. So in an industry where pricing is like so important, to be off by that much on just that one figure resulted in a lot of rate increases for policyholders. So that rate increase, which means people who held policies, who thought that their premiums were going to be stable forever, those premiums were increased at some point over their lifetime. Now, in the contract language, the premium was never guaranteed, but somewhere along the line, the premium staying the same for so long, maybe a miscommunication, people started to believe that those premiums were guaranteed. So that's difficult. When you've had that policy for 15 years or 20 years and all of a sudden you get a rate increase, you're like, what's going on, right? So that situation of pricing miscalculation, pricing error mixed with the reality of the situation, and then price increases caused a lot of the industry to say, whoa, what is this? And so at that point, a lot of insurance companies that had been offering long-term care insurance, they were like, wait a second, this looks a lot less profitable for us as insurance companies than we thought it was going to be. Looks like we're going to need a lot more research. Looks like we're going to need to put a lot more energy and investment into this product to continue to offer it. So companies that maybe didn't want to be in that game or it didn't fit with the rest of their portfolio decided maybe we'll leave this to people who have more invested, more interest in carrying long-term care insurance as part of their product suite. So what have we touched on? The drama with the pricing, the fact that fewer companies offer this product than before. And so now you have a lot of financial professionals who may have had early generation clients with rate increases who were unhappy. So they're upset. We all care so much about our clients. Nobody wants to be managing a rate increase on a policy. So a lot of financial professionals said, you know what, I don't know what's going on here, but I can't be recommending something to someone without knowing where it's going to land. So financial professionals said, I don't know. Insurance companies dwindled as far as numbers. So what do we have? We have a rebirth of the long-term care industry. So in 1996, as part of HIPAA, a lot of long-term care stability, rate stabilization legislation went into effect. And we also see that we have to be federally regulated tax qualified policies. So that means that every plan you buy is designed to be tax qualified. So benefits are paid tax-free, premiums are tax deductible in some circumstances. Premiums have to be run by the state. They have to be certified by the state. Am I waxing on too long?
No, you're going on. You're shedding so much light on things that people don't know about, including myself, that it's incredible. I mean, it really is.
I feel strongly. I feel like there's this misunderstanding that early generation of policies caused people to take a step back from long-term care insurance. And I really think we do our clients a disservice if we don't recommend it. So part of that kind of new generation now means that insurance companies have to get their rates certified by the state. They have to be priced correctly. They have to make, room in the pricing for those errors that were before. So like today, I can't buy a policy that's less for me than it is for my husband. Why? There's gender pricing. Women live longer than men. The insurance company now knows I'm a bigger risk for them than my spouse, and so they charge accordingly. Same thing with car insurance, life insurance.
Yeah.
Right? This is not like a new thing, but these were learnings, unfortunately, that the industry had to go through. And modern policies are priced appropriately. And the companies that are in the game are really engaged in long-term care insurance. I just was going to lastly say that we hear this criticism that long-term care insurance doesn't have a lot of companies, and so that must be a bad thing. And the closest parallel to this is actually disability. Look at disability insurance. There used to be 100 companies offering disability, and I think that industry has about a dozen. But it's not like people walk around saying, oh, disability is a dead industry.
Right.
Like, that's ridiculous.
Well, and then I also, again, and it's one of the things that I'm so glad, it's maybe touched the masses' hearts when we first started 62 Who Knew 4 years ago. Modern science, technology, medical breakthroughs, that's another thing that those actuaries really didn't take into consideration. And I had 3 classes this week the third one is tomorrow. So I'm in automatic mode now. But, when I was young, which was 100 years ago, I got shots for certain diseases, childhood diseases, and even if you got them, you lived. My parents' generation, they died from those diseases. My grandchildren don't even know those diseases exist. And what we have been told, by some of our guests and some of our future guests from the Weizmann Institute in Israel and other huge medical things, that the medical advances of the last 30 years are going to be dwarfed. They're Fred Flintstone compared to what's coming in the next 30 years. So I also think I've been learned from you and other people like you that, when you don't go on claim when you have life insurance, you're dead. And the insurance policy pays it out. But I think the other thing, and correct me if I'm wrong, is there was no statistics because of the medical breakthroughs. People were getting really, 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 really sick. They were supposed to die in 6 months, and they just didn't. And now it's 4 years later, and the insurance company's still stroking out the check every month because they need the money. And I'm not here to champion how great the insurance industry is, but I hate when people go, those lousy insurance companies, they pay every month. It is why your grandmother is being taken care of.
And some hard statistics, some real statistics on that. Like the last I heard, Genworth, who I already mentioned, pays $6 million a day in long-term care claims. And when I was at a conference recently, they kind of went like this, like it may even be more than what the last number indicated. So when you think about that kind of idea that maybe the insurance doesn't pay, they're paying a lot of money, a lot of money.
And the insurance companies, like I say about everybody else, this is not on mommy and daddy. They have stockholders. They have to make money. They have to pay people. They have to pay our premium. So again, I'm never going to be the host that's saying, large pharma and insurance companies, they're the best in the world. And no, they have their greed levels like every other industry. But the world survives off insurance companies. When you get into a car accident, you're depending on that car insurance company to cut the check for the next car or for your medical bills, God forbid. And you can complain in your 40s about a Genworth or MetLife leaving the long-term care world. I know at one time they were the number 3 in the country and they ran out like the house on fire. Snoopy just didn't want anything to do with it anymore. But they're still paying out millions of dollars today on their existing policies. And not millions of dollars a month or a year, but probably a day.
A day.
So, this idea of
and what's old is new again, right?
That's right.
What do we know? Genworth is coming back with a new product, and they're going to be under the banner of Care Scout. And even MetLife is looking at a worksite long-term care product.
Really?
I'm sorry, a group long-term care. So, there's nothing that says that insurance companies, once they're gone, they're not going to be back.
That's right.
So I think that long-term care insurance needs to be offered more and more and more, and not less and less and less. I think in the industry, if we have an understanding of the circumstances by which a premium can change. Nowadays, how can we change a premium? What can the insurance company do? And we need to communicate that to our clients effectively. Or if they don't like that, they can buy a policy with a guaranteed premium.
That's right.
So that those things exist now. And as an industry, we just need to kind of move past whatever feelings we have about the old products and do what's, ultimately in the best interest of the client, which is
move forward,
shifting some of that risk.
Go forward. Yeah.
Go forward.
We talked about a few weeks ago, and then we're moving over to John immediately. Our 8 shows. Is this number 9 or number 10, Anthony? Number 9. We have had many guests, 8 guests, but we do end up winding back to long-term care insurance with a lot of our guests, whether it's the number 1 annuity expert in the country and Tom Hegner or whoever it may be. We always get back to that. And I've had a few people go, is this a long-term care podcast or is it about everything of quality of retirement? I said, oh no, it's about everything of quality of retirement. And I'm not saying this for any reason other than I believe it in my heart. You really can't have that quality of life in retirement unless you have some long-term care insurance protection. Unless you're in the top 2% of the country. And I just had this argument with somebody yesterday, and I mean argument, that people above, how I argue.
John and I won't be surprised by this.
Yes.
John and I are like, okay, that makes sense.
Yeah, that makes sense. That, my clients are all worth $3 to $5 million, and they self-insure. And I said, that's bull. They don't self-insure. There's no insurance involved. They just can afford to pay the bill. The definition of his insurance is to put off risk. They're not putting off risk. They're just taking the risk because they can afford it. I don't know who came up with this term. I'm going to self-insure. There's no insurance. There's no deferring risk. You're just capable of writing the check, and God bless you. But that's 2% of the country. The other 98% of us need long-term care insurance. Thank you for what you just did for the last 15 minutes. You probably put more things in perspective for our listeners than anybody else ever has. Mr. John Thomas, Amada. Hey, my favorite in-home care company, possibly in the galaxy. Your industry also, because of longer lifespans and people being on claim longer and not dying from their cancer, getting actual treatment and living with their cancer or getting it cured, your industry has changed vastly too. So please take it over. I don't know how you're going to follow Cassandra, but take it over.
Yeah. Thanks, Mike. And you know, your statement is pertinent because we are planning on sending the next round of home care providers and caregivers to Mars, right? As we colonize Mars. So the galaxy is for real. I'm just playing. But
no,
who knows?
It's all right.
Who
it
knows
will happen. It will
right?
happen. Yeah. Cassandra's children will be doing LTC policies on Mars.
Yeah. Well, you know, I think home care correlates so strongly to long-term care insurance. It's a reason we're in this conversation as a home care provider and senior care agency, and the reason that we believe so strongly in long-term care insurance. It is the best way to pay for care, right? And I say that without question. You know, cost of care is increasing dramatically. I may have said this previously on the podcast, but you know, it's gone up. The cost of care has gone up something like 65% over the last 5 years. COVID had a lot to do with that. Inflation has a lot to do with it, but the cost of care, the cost of medical care is rising dramatically, right? And if you're using your own dollars to pay for that care, you're not getting the benefit of the kind of leverage that insurance provides you. So, you know, if you can buy an insurance policy that gives you $4 or $5 for every $1 you spend, why wouldn't you, right? I mean, you can be wealthy and pay out of pocket, but the opportunity with insurance is to leverage your current dollars and get more for what you spend, right? I think it makes a lot of sense, and there's a psychology to it as well. And I can tell you that when we have a conversation with folks in the home and we're preparing to provide care, folks want to wait until they absolutely desperately need support and care before they bring somebody else into their home. I mean, picture it, right? You're senior, you're aging, you have a lifetime maybe of experience and life in a home. You have a lot of valuables, right? That's where you feel the most vulnerable is in your home, and you're inviting a stranger into your home to care for you in your most intimate and vulnerable moments, right? Helping you bathe and get dressed and eat and be fed, right? And so it's a very vulnerable thing. And so the reality is that people wait, and often they wait too long to invite help. And now there's a lot of things that agencies like mine do to vet candidates, and we do background checks, and we make sure we have really awesome, loving, caring people that come into our seniors' homes to care for them, right? That become extensions of families, right? Sob and support families when that loved one passes away, and really become integrated, important parts of support structure and family. And it can be a really beautiful thing. But when you're in that moment of having to make the decision, it's incredibly tough.
Yes.
And there's the psychological element, but then there's the financial element, right? And you can have $1 million in the bank, but if Amada is there in the home with you and we say, hey, you need this level of care a day, you need somebody to be with you 10 hours of care a day while maybe your son or daughter is at work, or some other loved one is with you in the evenings, right? But you need 10 hours. Somebody's there with you at the house, right? And it's going to cost you $20,000 a month, right? With the way that the cost of care is increasing, you can write us a $20,000 check a month, or you can use an insurance policy, right? The folks that have insurance are far quicker to say, oh man, I'm glad I have this policy. This policy is going to pay out to cover this care versus me writing a check. It's a lot harder to write the check, even if you have the money. Because the truth of the matter is, when it comes time to spend money, we don't want to spend it on things that maybe we feel like are unnecessary, right? And a lot of people feel like it's unnecessary even when they critically need it, just because from a psychological standpoint, we don't want to spend the money.
That's right.
You've earmarked, you've worked hard for that money. It's in your retirement plan. Maybe it's in your home, right? And you want to pass that money down to your kids. You don't want to see it spent for your own care. And just
let me take 5 seconds, just because I'm the mortgage guy. $20,000 a month, you have $1 million in the bank. You're broke in 4 years and 2 months. That's the math. And if you're getting great care, and you are from Amada, and your doctors, because you have other medical coverages, hopefully long-term care insurance. But if not, you have your Medicare supplemental policy. Maybe you're a veteran. Maybe you're getting VA benefits. That $1 million is gone in 48 months and 4 years and 2 months. Now you're broke, but you're alive and you're happy and you're hugging your children and your grandchildren. Now where's the care coming from?
Let's do a little exercise on that, and I don't want to take up too much time, but if the bill is $20,000 and your Social Security is $3,000, and you've got $1,000 a month as an RMD, so that's a total of $4,000, and you get an insurance policy that can pay anywhere from $5,000 to $10,000. Okay.
Ask me the math question.
What's the math? Right. So if the balance is $10,000 a month instead of $20,000 that you're pulling out of that $1 million in the bank, how much longer does that last you?
You just went from 4 years and 2 months to 8 years and 4 months. And if you're in your 80s, I hate to say it, you probably won't be here when that happens. Nobody wants to live till they're broke. And I don't care if you're broke now or rich, but that's not the goal, to die broke. And there actually is a great best-selling book called Die Broke, and we'll probably bring that author on one day. But that's about having fun with your money before you die. That is not about not having the proper medical attention. And please go ahead. I want to take more of your time, John.
Yeah, no, you're absolutely right, Mike. And, there's the question of dying broke and spending all your money, but it's also how do you make, wise financial choices and investments? A lot of long-term care insurance policies, when you look at the math, they provide a financial return that's going to, in many cases, out-earn what you'd earn in the market, right? The protection, the insurance protection it provides is going to out-earn what you would likely earn in the market, and those benefits are guaranteed, right? When you file a policy claim, you know exactly how much you're going to get when you need it, right? And so I think from that level, it just makes smart financial sense. And I think one of the reasons, and I have a follow-up question for you, Cassandra, I'll kick it back to you in a minute, but I think one of the reasons that a lot of folks are not preparing is because there is this general assumption, like with Social Security, right, that there is some government benefit that's going to take care of us as we age. And to a degree that is true, but you have to understand clearly what those government benefits cover, right? And so broadly, there is CMS, right, which governs Medicare and Medicaid. And Medicare is available for seniors, right, folks that are aging, and it provides medical benefits for seniors, right? And then there's Medicaid. Medicaid is for folks that are impoverished, right, that fall below a certain asset and income limit, and they need support. And so there's Medicare, Medicaid. Medicare is for old folks, as they used to say, and Medicaid is for poor folks, to put it simply. And that's probably not the best terminology, but that is how they used to
I'm
put
good with
right?
it.
You're good with it.
We're also not surprised, Mike.
Hey, it's pick on the host day no matter who I have on the panel. You notice that, Anthony? Yeah. Go ahead.
And Medicare provides medical care, medical benefits, okay, for seniors. And so you're aging, you have an accident, maybe you fall, you break a hip, you break a leg, you go to the hospital. Medicare is going to pay for your hospital care, your hospital benefit, those costs, and they're also going to pay for the medical elements of your recovery. And so there is a little bit of benefit that will pay for your rehabilitation from a medical perspective. So you need rehab after you've broken your leg and you're recovering. Right, Medicare is going to pay for some rehab. There's benefits in Medicare to pay for typically up to 20 days of recovery rehab. You can extend it up to 100 days potentially with a copay. Now that is being ratcheted down to a degree. I could say that most folks are not getting 20 days of paid recovery by Medicare. But that aside, that's what the program potentially pays for. Now what they don't pay for is custodial care, or care at home for activities of daily living, the kind of things that long-term care insurance pays for. So you go to the hospital, you're discharged, or you're sent to a skilled nursing facility for rehab. Maybe you're there for a week or two, you're sent home. Medicare will pay for home health services. Now, home health services are health care at home. That means maybe a nurse will come by the home once a week to do an hour checkup, to check on a wound, to check on how you're healing. Maybe that nurse comes to the house 2 or 3 times a week, but it's typically for a couple of weeks, right? They're checking on you medically, and home health and Medicare pays for those visits. What they don't pay for is the kind of care that will allow you to stay at home. So if you need extensive supervision, if you need somebody to help you with a bath, if you need somebody to help you dress in the morning, and you need somebody that's there with you because maybe you have cognitive impairment or dementia, that kind of stuff is not covered by Medicare. And so if you want to stay home, you don't want to end up going to a facility, or you want to transition to a nice independent living or assisted living community, the government's not paying for that. Right. And so that is out of pocket. And so your only other recourse is to have planned by using long-term care insurance or by some other measure. Now, they say that death and aging are the hardest things to talk about. And so, having said all of that, many of us are still going to hesitate to talk about it because it's an uncomfortable topic. So Cassandra, as a leader in this planning space and primarily as an expert in long-term care insurance, I think as insiders, all of us love to hear how one another talk about this hard to talk about topic, right? How do you engage with families and really break down those walls of vulnerability and planning and get them engaged in planning enough to buy the insurance? What is your approach, Cassandra? How have you found success?
Well, I think first it's really important to kind of know who you're talking to. I think sometimes if we know someone too well, that can almost be hard because you don't want to ask some of those questions. But if you don't know one at all, like know someone at all, that's also hard. So you kind of want to, usually we're starting with people that we really don't know or who are just meeting us for the first time or the second time. So I find that asking a lot of questions about health, their personal health, their family history, and to a large degree, their finances. Just want to get people talking. I explain why I ask every question. Every question I ask has a purpose. I'm not just trying to waste time either. But I think letting people talk about themselves, getting to know me via those questions, I think is really important. But then and I think most professionals in our space, we really don't dwell on what I'm going to call like graphic stuff. Like I rattle off the ADLs maybe one time during a call.
Tell our audience what ADLs are, please.
Oh yeah, activities of daily living, John referenced. So eating, bathing, dressing, toileting, transferring, continence. Mm-hmm. Right, so you could spend a lot of time asking people about how they feel about those. Which one of those concerns you the most? Like there's a way that this could go in a really crummy, silly sort of a direction. And so we try to keep it very high level. We don't talk about, yucky things that people might have opinions of facilities. We don't need to go there. Like it's okay. But I do think it's very important to ask people what their priority is from a long-term care plan. And people aren't shy about that. I let them take it in whatever direction they want to go. Like I just want to stay in my home. The only way I'm leaving is horizontally. Mm-hmm. Okay, that tells me what I need to know. Mm-hmm. Okay, great.
Boy, does it.
Right. And if they want to talk about some of that ADL stuff as being their primary concern, like maybe a spouse providing that physical care or a child providing that personal care, then they're more than welcome to do that. But some people just aren't that way about it,
It is very emotional. I had a guest that you both know, and I'm going to mention his name because he's a cool guy. And tell me if I'm saying it right. Sean DeVoe. Sean, do you know him from? Okay, he's a superstar. And we had a lot of fun. He was on the 62WhoKnew television show a few times. And we were talking, I think Mark Goldberg was on too. And this subject came on, how do you close people? How do you don't want to sell somebody a long-term care insurance. It's very similar to my world. I don't sell anybody a reverse mortgage. If they need to use their home equity to increase the quality of their life, I want you to get it. But I don't go to someone's home or do a Zoom meeting with the goal of selling them something. And Sean said something that Mark and I just went, and it's not my style. It's certainly not Cassandra's style. But Mark said to him, how do you get people over those yucky topics? They know they need this, but they just don't want to take that emotional step of when they can't do one of the ADLs. And Sean said, I've got this down pat. This is why I'm the best. And we all went, go ahead, tell us. And he went, it's easy. I just say to the man, you're more man than me. If you're fine with your daughter helping you in the shower, then you don't need long-term care insurance. He goes, then they usually go, where do I sign? I go, yeah, that's not my kind of clothes. Even me, and I'm aggressive, but that's not my kind. But he said, you know what? Sometimes you got to let these people know. If there's not a professional in there doing it, then it's one of their loved ones. And if they're cool with that, so am I. And I liked what he was saying, but that's not what I want to go into someone's house and say to somebody.
I was just going to say that I struggle with that a little bit just because I actually I don't see myself as, I'm not trying to sell anybody anything. If you don't see value in it when we begin our conversation, nothing I say to you makes a
That's
difference.
right.
And so my job, I truly, to the core of my marrow, my job is to help you figure out the best product, the best place for you to be to address whatever your concerns are.
Yeah.
That's
the way.
I don't like that.
No, I didn't like it at all. I mean, even, Mark's aggressive too. Mark and I went, on camera, we're, nah, can't see saying that. But, to each their own. Something also just, before we go on the equity end, John, I want to say something about what you said, but are you cool, John? Are you more to do?
No,
this is
no,
Inside
no.
Edition. This is all you.
You're absolutely right. I mean, just I think it's, to close the loop on that, it's exposure, right? I mean, we can evaluate what are the best options for us if we've been exposed enough to understand what our likelihood of something really is, right? In a real way, not in a mathematic or statistical way, but in a real way. And I think that's one of the reasons that folks that explore on their own long-term care insurance, the most are folks that are going through it with a loved one, right? Or going through it with a parent, because it makes something real, right? And there are men, like, without that kind of graphic example.
Yes.
There are so many men that say, "Yeah, I'm."
I hope he doesn't get mad at me, but that's what he said. It's on tape.
Yeah.
I wasn't into that kind of class.
Horizontally, but the truth of the matter is, as we age and we become frail, we become dependent on other people, and other people make decisions for us. We lose the capacity or the right to make decisions for our own care because we're frail enough. And so the decision isn't always going to be yours. And I think that's a hard thing to accept, and it's a hard thing to let sink in. I mean, we get calls every week from wives who are caring for their husbands, and they become frail enough that they fall, and the call is, "Hey, I can't do this on my own anymore. I can't lift my husband off the floor. I had to call the fire department." And that is a call we get every week, right?
And imagine how the man on the floor feels.
Yeah.
He's frail. He's getting sicker. He's not as independent as he was. Man or woman, I don't know why I said that. But for their child or husband or wife to go, "I'm sorry, I'm calling the fire department. I can't lift you." Imagine their despair at that moment. Yeah. It's just heartbreaking.
And for the person that's, aging and experiencing that, the decision is eventually is out of their hands, right? And so you're not always going to be in the position to be the decision maker. And that's hard. So part of this planning, even if it's not long-term care insurance, I think that's the best part of the plan that you can put in place. But even if that's not it, having a plan and putting a plan together allows you to do that decision making ahead of time, so that you're not trying to make a decision when it's too late and it's out of your hands, right? Or you're incapacitated to the point that you can't make the decision. So planning and discussing it with family is so critically important.
And you probably see all the time, John, that people actually go out of their way to a really large degree to honor what they think the wishes of the person are. Absolutely. So if you don't, even if no insurance involved, doesn't matter. But if you haven't said what those wishes are, then you leave everyone around you to kind of like try and figure it out or do what they think it is, or worse, if you have multiple children, argue about it.
That's right.
Right, and then here we are.
I think one of the most incredible things about in-home care, it's so emotional to make the decision to buy long-term care insurance for all the reasons that you and Cassandra are discussing. But once that decision is made, and hopefully you never need it. Let's look at it that way too. Hopefully you never get a check because you're healthy and you die in your sleep peaceful and you live to be 110. But when you do need it, the only emotion you have is happy because there's a check every month. So the emotion is up front. In your industry, and I'm talking from personal experience now, I mean, I planned on being my father's caretaker from the time I was little. I'm going to take care of my dad when he needs it. And when that came, and I was in my 50s and he was in his late 70s, I was proud to do it. But as it got worse and the shower thing happened, and you see I'm not exactly a skinny guy, but even my son and I together, Dad was 6'1", 210 pounds, and dead weight sitting in a shower, we couldn't do it. We had to call 911. And you've heard me tell this story before. And the first time he had a little accident, and I was cleaning up. This was a greatest generation, highly decorated ex-POW, World War II hero. He did not like this. And I remember him saying it to me in these words. I won't use his words because it'll make Cassandra blush. But I don't want you doing this anymore. I know we planned on this. I don't need you to be my nurse the last few months of my life. He had congestive heart failure. I need you to be my son. And it hurt a little. That next day, we got in-home care. But I will tell you, for the next 5 months, when that in-home care person walked in the door, it was the biggest sigh of relief for me for 6 months because I knew Dad was safe. I knew I could actually get 8 hours sleep without worrying about, did he fall down? There was many of them. They came to Dad's funeral. They cried with us. Next section. It's just an incredible thing that both your industries do.
I feel for you, Mike, and I feel with you. It's a shared experience for many of us, later in life. And the goal, I think, of 62 Who Knew is to prepare and have those conversations earlier, right? Before we're having those conversations at the time of need. Yeah, I know, Mike, your dad was an awesome guy, and thanks for sharing.
All right. So this is going to be a slightly shortened version of 62 Who Knew because it's Inside Edition, and we're doing great so far. But I don't want it to be, we all agreed before the show, so self-serving. There's a difference between Inside Edition and, hey, look at us. That's not what this is about. But we're going to spend the last 7 or 8 minutes talking about what I do, or what I try and do, which is my expertise in the country, which is the use of home equity during retirement. And this has staggered me for 20 years since I met a man that you both know, Peter Gelbwax, who is considered one of the godfathers of long-term care insurance. He watches every show. He's in retirement now. And I think Peter's going to laugh at this, but don't worry, he will laugh. But I think Peter's first LTC policy actually was for Fred and Wilma Flintstone. That's how long he was doing it. They had to cover the cave. How hard it was to get there with dinosaurs and crap on your way. But be that as it may, the reverse mortgage world and the long-term care world are so synonymous in certain ways. You help forever. There's a limited amount of equity that a person has in the house that we can give them access to. Then it's gone. You write policies that take care of people for as long as they need them, as long as they pay the premiums. But from 1962 to approximately 2009, 47 years, the reverse mortgage was a terrible product. And my reverse mortgage brothers and sisters hate this. When I say it on the podcast, when I say it in my public speaking, I've said it on national TV a number of times, it was terrible. It was a needs-based product of last resort. Oh my God, Mom can't get to the drugstore. Mom can't do this. They're having trouble going to the supermarket. We want one of those damn expensive reverse mortgages that's going to eat up our equity. And that's what it was for 47 years. But after 2009, which was the record year for reverse mortgages, HUD, who is the people that guide reverse mortgages, the Department of Housing and Urban Development, FHA, they ripped the reverse mortgage apart and put it back together and made it quite a bit safer. Then they did it again in 2013. Then they did it again in 2016 and 2018. There hasn't been any major since then. But from 2009 to 2018, the reverse mortgage went from that last-ditch piece of crap product that was too expensive. Even though I was doing it then, I was apologizing at closing. But I was giving them $200,000 to pay their medical bills. And, so I wasn't the enemy, but I would look at this and go, the costs involved in this. And they were all going to the government. It wasn't profit to the mortgage company. It was our good old government. That's a different show. But for 7 years, 8 years in a row, the product was improved. But it's so hard to get people to forget those early years, like with your long-term care product. I still run into people. Oh my God, my grandmother lost her house, blah, blah, blah. Oh my God, I'm so sorry. Was it before or after 1988? I think I was 12 years old. I'm sorry that happened to grandma, but that's not today's reverse mortgage. And the truth of the matter is, people retire and have always talked about this, every financial planner in the world, and I'm not a financial planner, I'm a mortgage guy, and a host of 62 Who Knew, of the three-legged stool of retirement. That's what it's always been. The first leg is Social Security, because we all get it. no matter how you complain about this country, great country. Everybody gets Social Security. Different ages of when it's fully taxable, when it's not, when you have to give back some of it. And God knows if it's going to last the next 10, 20 years. But it's here now, and it's been here for a long time. The second leg of that stool is pensions and retirements. But we all know that in today's world, unless you're a school teacher or a fireman or a government worker, most large United States companies did away with pensions 2 decades ago. They just couldn't afford it. We're a 401k country now. We're an IRA country now. People giving a little bit towards it, but it's the hardworking American that's making the biggest investment. And congrats and kudos to the employers that contribute. So first stool is Social Security. Second stool is pensions or retirement. Third stool is your own assets that you have managed to accumulate. And we all know that in the last 20 or 30 years with inflation. We're not going to go through that, but everybody knows that, again, except for the top 2% of the United States of America, with the cost of gas, cost of bread, cost of a head of lettuce, let alone your homeowners insurance premiums, your interest rates. Most people are not retiring with a fortune in the bank. When I say most, I mean 98%. The fourth leg of the stool, because of longer lifespans, we're right back to the 62 who knew premise, why we do what we do here, is the use of your home equity. It just is. I don't care if you like reverse mortgages or not. And it doesn't have to be reverse mortgages. I like it because it has no payment. And the last thing a broke person needs at any age, is another payment. When you think about that, we're going to bring on economists to talk about this in June. I don't have $50,000 or $60,000 to buy a car, but I need one. I got to take the kids up. In fact, I want an SUV. That's going to be $70,000. I don't have $70,000, but I can do it for $800 a month over 8 years. Oh, wow. That equals $100,000 because of interest. So you didn't have the $70,000 to buy it, but you do have the $100,000 to pay it. And we wonder why we are a nation of debt. Now, I don't know the answer to that. Oh, boy, then we'd all be rich because I'd share with both of you. Okay? I don't know the answer. But think about that. We don't have the money to do it. So let's spread it over time and pay interest and pay 2 or 3 times as much. Okay? You don't have to get a reverse mortgage. If you have a free and clear home, get a HELOC, a very common term, a home equity line of credit. And you access it as you need it for your quality of life, for your in-home care payments, for your long-term care insurance payments, for anything, to take a cruise, to go see the children. But it comes with a payment. You could get another 30-year mortgage. Forget a HELOC. You paid off your house 20 years ago. You're that generation. You had a mortgage burning party. I haven't had a mortgage payment in 20 years. Yeah, you haven't had a vacation in 20 years either. I've always say that, here in Florida.
Wait, what?
Yeah, I run into people all the time that say, Michael, I haven't had a mortgage payment in 20 years. Now, these would be friends of mine or parents of friends of mine. I don't want you to think but I'll say to them, yeah, I know you haven't had a mortgage payment in 20 years, but you haven't had a vacation in 20 years. Remember, this is me. We know each other.
I don't know what that means. Like they don't go on a vacation because they don't have a mortgage?
No, they're so happy that they're not in debt, but their monthly income doesn't equal their quality of life. That for the last 15, 20 years, isn't that great? We have $600,000 in equity in our house, but you don't play golf as often as you used to because your income is down. Your annuities and your CDs are paying you squat. Inflation is more than your rate of return on your investments. You're so happy that you paid off that mortgage. When's the last time you saw your grandkids? Take $100 down of credit and enjoy life. You're 76 years old. That's what I meant by that. You can't go to the cruise line. You can't go to the hospital and say, I want the best care possible. I don't have long-term care insurance, but I want the best care possible. Well, that'll cost you $22,000 a day. Well, I don't have that, but I got a lot of equity in my house. The hospital's not taking that. They're taking your long-term.
I feel like I have to leave at a cliffhanger, but I just wanted to bid you guys adieu, and I can't wait to hear the rest of this when I pull it up.
Well, I'm done.
See you guys next
I am
time.
done. Equity
No,
it's okay.
You don't have to stop.
I don't want you to. Okay. Well, thank you for being here on Inside Edition. We will see you next week. We have unbelievable shows planned in April. Unbelievable shows. This home equity thing, look what we're doing with Amada. We're going to help not hundreds, maybe thousands. I'm hoping tens of thousands of people that are currently going, I need in-home care. And let's not scare people with $20,000 a month. I'm just going to say that. How about $5,000 a month?
Sure.
And if you have $100,000 in the bank, which most people don't, is that what you're going to spend it on? Because hopefully when Amada leaves, you're better. That's another thing that I think people don't think about with in-home care. In my father's case, he was gone when we didn't need our in-home care. But I have many friends and relatives that got that knee replacement, got that back replacement, had a kidney transplant. And when they were fine and in-home care walked out the door, they still had another 10 or 20 years of life. Do you want to be broke? But I have equity in my house. So the use of home equity, this is my point, and then we're going to end the first 62 Who Knew edition, Inside Edition. The use of home equity, whether you like it or not, due to longer lifespans, which will be doing nothing but getting longer and longer and longer as we have more scientific and medical breakthroughs, is something you have to do. Whether you like, I hope you like it. I hope you think it's a good choice to have a high quality of life and a little less equity. But even if you don't, you still got to have a high quality of life. So on that note, unless you have something to add, I appreciate you and Cassandra having our first Inside Edition. I know I learned from both of you, and I think this show is going to be a lot more widely accepted. You know, this was an experiment, but next month we're going to be doing an Inside Edition that is going to be focusing on financial planning and why people think, well, I don't have millions of dollars. I can't get a financial planner. Yes, you can. And the reason your friends have millions of dollars is because they got a financial planner earlier in life. And so we're going to have some interesting shows in April. Thank you, my friend, as always, for doing this.
Thank you, Mike.
Really appreciate it. And we'll see everybody next week.